All right, ladies and gentlemen, I hope you had a wonderful day. It was another boring day in the markets, but we're still going to have an exciting video because we got a little surprise from the Fed and Neel Kashkari today, and it's bringing up a big conversation about Fed credibility. So I got a lesson for you. I have even some other questions that the chat asked, but I have the keys, all that good stuff. We're going to quickly recap what happened today, what we're looking for tomorrow, and then I'm going to go over why you really got to pay attention to what the Fed is saying and why none of this stuff is new. So, Chad, you know the drill already. I need the thumbs up. I need the likes and all of that. But yesterday, y'all came in clutch. So, listen, people going to show up late and all that. Just tag below when we get to there because maybe you don't want to listen to all this. I get it. Hopefully, you still like the video, but hopefully, you will appreciate some of these lessons. So, it should be very exciting. Tomorrow, unfortunately, there is not that much priced into the market. However, we are finally getting through this slow week, and before you know it, you're getting a couple more earnings, and then by the end of this week, we will be leading into a big week with CPI. So, Chad, drop that thumbs up, do all that good stuff. Hopefully, I see you there, but now, run it, baby. Oh, wait, we're live, too, Monday through Friday, 30 minutes before open, youtube.com/the stock market. Is this a weird time to put this, if that in the, okay, run it.
A lot of people in the government pay more than the teachers. Why they always want my money? Both the liberals and preachers separate the church and state, but devil on my speakers, and they told us not to hate, but they don't apply to
Right off the bat, as far as what happened today, we should be able to run through it pretty quick because, like yesterday, there really wasn't much. It's not like you woke up to any crazy data. There was a couple of earnings, and some did good and then sold off. There was deals that we heard about all day, from like Peloton to International Paper. Even throughout the day, we were getting late news pops, everything from Pfizer to Dow and LYB, and there was these events, but there was not any big drivers that was moving us, and the only thing on the calendar was the Fed speaker. We're going to talk about that, but the other thing was the same thing from yesterday. We just had 7 hours of war headlines back and forth as that Israel-Rafah thing keeps playing out as it has been. So getting into the keys now, very simple. It was slow, but what happened with Mr. Kashkari, he low-key had a pretty decent effect, and I didn't really notice it till looking afterwards, but that's what made sense. I put Kashkari, that's supposed to be Kashkari, but he was talking about inflation getting stuck at 3%. That's why he kept mentioning it. He said there's no way he is going to be cutting more than 2 times this year. He said it's more likely that they do 1 or 0, and he definitely took a hawkish stance, but he was already one of the hawkish members on the Fed. So it's not like it was a big surprise, but he definitely added some new hawkishness after all of the data. And he even mentioned the market exuberance and was talking about how the market was just down and now it's up. And that's kind of a big factor. But he's the only Fed person who said that in the last like year and a half or so, because it's a trap. But all in all, he said these phrases. It got the market moving. But what I want you to see is that the bonds actually gave up their whole entire rally after he started speaking today. So he came on at like 11:30. He was good for like 10, 15 minutes. And then before you knew it, by the time he was like wrapping up in the middle of it, this whole bond rally sold off. You went from like 1.3 on TLT, and this is like your first real rally in days, to 0.5, which was still good. But it was really interesting to see because we didn't expect much of an effect, and it's not like this really was. It didn't change the story too much, and that's what I had here, but you definitely got a little bit of a reaction there in one element of the market. So the rest of this week, even though it's going to be quiet, I would keep your eyes out for any of those other Fed speakers, and then as we get into this CPI, this is a big topic I was talking about today, and why these Fed speakers are so important, and everything leading into this is because we are about to enter into June. 6-8 months ago, everybody thought that is when we were going to be cutting rates. This was a Christmas of some sort, and at the very least, even if you don't want to celebrate that holiday of the Fed cutting rates, at the very least, we get a SEP in June. So this is all kind of setting the groundwork with earnings and all of that. And now on these weeks where we don't have much, these Fed speakers, we are definitely going to keep our ear tuned, but just like today, it might move some things, but not change the whole story. So that is key number one. The second thing you got to look out for, because we are not expecting much this week, you will be getting a 10-year auction tomorrow, and it might be spicy. Maybe we get some volatility. There is a lot of bond supply this week. We started today with the 3-year bond auction, and even though that was larger, it actually had some decent demand. So no bad signs for now, but if this 10-year comes in bad, maybe it gives the market a reason to freak out, because we've been talking about that 10-year at 4.5. We have been rallying up a lot. That bond yield has came down, and it's even below 4.5. I think it hit like 4.3 at one point. Ira Jersey, some big bond people are talking about it coming down to 4.3, 4.25. It starts to get really bullish. Anything below 4, then we start getting real crazy, but no one's expecting that yet. That's word to the bond bear market, but that's a big key to watch out for tomorrow. Other than that, you're not going to be getting much. And now to tie it into the last key, if you haven't realized, this has literally been the best 3 days of the year. It doesn't feel like it because it kind of came out of nowhere. And just like October, it's like you were just feeling a little bit of bearishness. But fact of the matter is, we got above 5,200. The high is 5,260. Last time we were above 5,200, it really started to run. And even on the way down, it was a little sticky. So this is a pretty big level. But if you haven't seen your NASDAQ or your SPY chart, we are getting right back up to those all-time highs. And Mr. Kashkari commented on this, so I don't know if that's going to be a new trend with the Fed, but point is, you got the bond yields calming down, and I think that's the big reason. And this is what I'll tell you, just like last time when the bonds were around here and we were getting worried, yeah, the market may look good for now, but leading into CPI, then the rest of the earnings, but mainly that next Fed, if there's any excuse to get those yields back up, I don't know if the market is going to keep going. So this was something that we talked about even before we hit highs and even before we started coming down. Like we were saying, it just might be harder for the market to go up when those yields get back up again. Right now they're dropping. Sure enough, we're right back up. Let's see what these events do. And in the next couple of weeks, if the bonds cool off, I think you're going to get a green light. If not, then it's still going to get choppy and all of that good stuff. So, Chad, I hope you're ready for all of it. But now, let's get into some questions and let us get into the play. So, right off the bat, I got a couple of different plays. I think this first one might surprise you. This was my first play in the morning today. I grabbed one of these May Palantir calls, $25 call for 19 cents, and low-key, I like their earnings. I was surprised that they sold off. I think the reason is they're up like 30% or something, and they're still killing it in its valuation and high bar. But if we're going to get bonds coming down and maybe some of the squeeze and crackheads come out, I think that was a good earning. So if the market wants to pick up, or excuse me, if Palantir wants to pick up with the market, I do think there could be a continuation in store. And after that big sell-off, these contracts, I grabbed it for like $10 or $19, but I'm pretty sure they were going for like $150 the day before earnings. So now I'm down to play it. But that was play number one. Watch out for that. Play number two, oil. We had a couple of talks on this, and I did get shaken out of it yesterday, but I had a bunch of discussions, and the way I'm looking at it, it's either $79 breaks out to the upside, getting us into 84, or if we can't hold the 79, it's going to get you down to 75. So given I'm at the middle of the ranges, I'm going to either look for after it breaks out, or if it kind of comes down to 75, 72, to try to go for it. Otherwise, if I do go earlier than the price action, it's probably going to be on a news headline. That should make sense, right? Right? You feel me? All right. Well, that is play number two. And then finally, this one was crazy today, man. SRPT and Pfizer. So it was wild. We saw SRPT have a crazy pop. Then Pfizer started to drop. And my experience was like, oh, yeah, that's probably a buyout. We couldn't find any news. One company pops, the other one drops. I'm like, okay, Pfizer, they've been saying they want to buy stuff and doing all this, but give it a couple minutes. Someone in the chat is like, Pfizer killed a child. And we're like, what? And then we look into it a little bit more, and it looks to be a news report. Then Troy gets me this news report. It looks like this little thing. I'm like, what? And they said they got a letter from this muscular dystrophy group. And I'm like, okay, go search that. And then Troy searched that, and then he found it, and then we found it. Then it led us to this website here. It's the Parent Project MD, and they were talking about literally how Pfizer contacted them and said that a child passed away in a study. And then you go and click and they have the letter here. So we were able to confirm it. A lot of the bigger outlets, it took them a little bit, but the weird part about it is that you still don't have a filing from Pfizer, and that's why I'm putting it up here on the plays. It's a sad story, all of that. I know some of you like to trade stocks and do the morality, even though that's no other issues of morality in your life because, oh no. But the point is, this is going to play out, and I think the reason why we haven't got a filing is because they said they're going to announce the drug results in a couple of weeks, or the trial results. So I do think there is going to be some big movement, a big update, and it's going to come in a couple weeks here after they release it, and it'll probably benefit SRPT and hurt Pfizer. It just depends on what the outcome really was and as they explain it, but somebody dying in a clinical trial is not a good thing usually. So we'll find out how this plays out, but what I'm trying to tell you is that it was weird how this news came out here and the way it was kind of structured, and we're like, wait, what's happening? I think it's just tied to the data release, and I would keep that in mind if you are looking for some more movements or updates on any of these two. So that is play number 3. As far as everything else, the plays that I made today, I grabbed that Palantir one. I did make some earnings plays. I only went with Twilio one way, 80 cents. It was like a little bit above 2 standard deviations, but they kind of had that pin. We've hit a Twilio back in the day there. I know they have upside. They're in that tech space, so I figured, hey, 2 standard deviations. They've been beaten down and battered. If they could get that turnaround earnings, I think that $20 for 2 standard deviations was worth it. I don't think they ended up doing good, so that play is probably going to lose tomorrow and then win. I played this one last time. I got a small hit on it, but I played it despite it not being a big mover. They were pricing in a little less than how they moved prior. Remember, the preview said they were pricing in 6. By the time we priced it, it dropped down to 4. So I took that as a good sign, but the thing is, Win doesn't really have big earnings moves. So I went against my better judgment, but I liked how it was looking. And then we also got to hear from Caesars and a lot of things, and even China's mixed into it. So I figured, hey, $50, 2 standard deviations. It's not expected to move, but at the very least, in this case, I think 2 standard deviations was about 8%, which is more than possible in about a week or so. So I like that. We'll see how that plays. They had a good earnings, and then we will find out where it takes us. But that is all I have for the plays. But now, man, let's get into it, bro. Questions of the day. And I like this one, man, and I hope you realize, I don't like banks at all in terms of answering questions sometimes, but I love you. I want you to know that because I'm going to show you what I did for this one because I had to show you guys the filings. If you know me, I hate going over bank file. I absolutely hate it, but this is the question. They said, how are banks making money off of debt if borrowers are defaulting? So I have it here. Maybe I should put a little bit of a space there to make it look a little better. The easy answer is rich people and fake money. Okay, that's the easy answer. Why are these banks making money if everybody's defaulting? Rich people and fake money. That's it. That's the easy answer, right? The real answer, economically, you don't want to sound like a tinfoilist. Very simple, is that not everybody is defaulting right now, and those that are close to defaulting probably have a job, and that's what kind of staves it off a little bit. But that's the first part. That is in relation to the consumer. When you ask that question, if borrowers are defaulting, who are you talking about? You have to look at the consumers. But now the other part is that these banks own a poop ton of interest earning assets. So it's like, how are they making money if people are not able to pay credit cards, if loans are defaulting? How in the world do these banks make so much? Simply put, these banks are raking in cash off of simply holding assets that return interest and even making money off of your money that you have deposited and then collecting interest. So literally, these banks can sit and do nothing and make as much in yield as their worst borrowers will lose. And if you don't believe me, let me show you. This is, and as I said, I went to the filings. This is JP Morgan, and I hate going over bank filings, but this is what you got to look at. Average interest earning assets. This is in million. They have $3.3 trillion of assets that earn interest. Here's the crazy part. Interest rates are like 5 right now. On that 3 trillion, or they do their exclusions and all of it, they're making about 2.7 to 3.85%. So simply put, they have $3.3 trillion that they are getting paid 3.85% on. That is a lot of money. The other one, and this is what comes into it, and if you are interested in who is defaulting or not, there's several types of ways to look at it on a bank filing. There's provision for credit losses. You could see loans that are defaulted 30 days, 60 to 90. There's another term for it. I'm blanking on it. But even then, this is the same company, JP Morgan. They are assuming that they will lose $1.2 billion in credit losses. These are like bad loans, right? And that's out of their total $144 billion of loans they've given out. They're expecting to lose like $1.28 billion a year on those, but go back to your net interest income, they're making $3.7 billion off of that interest alone. So that's why net interest income has been so important for the banks, and it's just simply put, yeah, these consumers can start to do bad and maybe these provisions go up, but as long as interest rates are high and these banks don't take any crazy risk, they have a lot of assets that they are just sitting making money on, and not to mention making money off of your money. So hopefully that answers your question there. Maybe we could talk about this a little bit more. I'm always down to follow up. And now question number 2. Can you do an update on Bill? I know the basic stuff such as not selling until the rate cut, but what about how fast you will sell out or switch to cash? Only sell when you need to buy for the long term? Well, first and foremost, you use Bill as a means to an end and don't ever view Bill as the end. Bill, short-term capital to get yield on. It should be something that you use to help you achieve a goal. Your goal should not be, I just end up sitting in Bill forever and all I do is collect 3-month yields, because at some point maybe it won't be like it is now, because it wasn't like that for the other 10, 15, 20 years or not. So that is one of the biggest things you have to understand with Bill. It's a means to an end, and it's an easy way to get yield right now while you are waiting to deploy your capital. So right now, I don't have anything in Bill for a couple of reasons. One, I moved the big account to Fidelity, so I don't need any of these instruments to get that 4 or 5% because they offer that through their cash options and their money market. Even then, on the TD Ameritrade account, it's a smaller account. I was using Bill, but now I just don't have any cash in my long term because I have already been deploying it. So that being said, if I did have, let's say, 20% cash, 20% I believe is the max you should hold in cash. At that point, you should start using it. But if I did have that in Bill, I would have already been using it towards the end of the year. And this is why I wanted to answer this question, because towards the end of the year, I started telling people this on stream when we started noticing the big rate cut expectations in the shift, why I was saying we might want to move, because if the future plans are in fact that the rates will be coming down kind of soon, we got to think about where yields are going to go in the future and locking some stuff in. And now there's some good deals out there, not all the tech names, but there were some cheap names with good yields. And depending on if we actually come to fruition in cutting rates and maybe a couple years down the road as it normalizes, you may never get to see some of those yields again. And it was offering that opportunity to start slowly moving out of Bill and going into value. That was something I was talking about a lot. But regardless, even if you didn't do that at the end of the year, I want you to understand the general theme here, because you don't want to have too much cash, especially if the expectation is towards the end of the year, beginning of next year, these rates are going to come down. That fixed income strategy is going to change a little bit. But even then, I would not be in any crazy rush to move out of Bill. So even if they do cut rates and if they do it by 0.25%, you don't have any rush to exit Bill, but you really have to understand what's going on. It simply means instead of 5% on the short term, they cut by 0.25%, you will start to get 0.25% less. And then if people forecast even more aggressive cuts in the future, then those yields might start to drop a little. But now You just have to figure out and understand, okay, what does a quarter point, half a point mean? How much does this change my strategy? So you should start thinking about getting out, but it's not as if Bill is going to change fundamentally really fast if there's only one small rate cut. The only time and the only instance I would get out of Bill fast and immediately is if the cuts were to 0 and they did it fast and surprisingly. If tomorrow Powell says we're going from 5 to 0, I would get out of Bill because Bill would still lock in this month at 5, but if the rates go down to 0, you're going to be going from making 5 to 0. So that's the only reason. Otherwise, you hold as long as you like until you're getting your long-term or whatever, but it depends on your goal. And the thing is, just don't forget this. It is a means to an end. It is not the end. And that's why even towards the end of the year, if we're starting to get subtle shifts, we have to think about using that cash, especially if you have 20%. Towards the end of last year, I did have some cash, and we started deploying it and putting it into other names. So this doesn't mean use all your cash, but if you do have more than 20%, no matter what's going on with Bill, I would start thinking about that. And even then, if they do cut rates, if you're not finding good deals and don't feel safe, Bill's still going to offer you a great return. The only time this play really does disappear is when rates do effectively go to 0. So hopefully that helps. You do have a follow-up. You let me know. And now finally, let's get to the economic lesson, baby. Somebody tag this, please. And I appreciate you if you did. Did you like the video too? I could give you that reminder. But, bro, why do they keep talking credibility? It's funny. We heard Kashkari today, and he kept saying credibility. He kept talking credibility so much, everybody in the chat was like low-key clowning on it. And everyone's asking, why does this keep coming up? Why does this keep coming up? And I thought this would be a good time to expose you to two different things and give you a real textbook lesson. And this is what I want you to understand. Fed credibility, this is a religion that was practiced well before your time, my friend. Fed credibility is not a new thing. Fed credibility is a pillar of the central bank of doing anything, and this has been around in academia since 1977, 93, 2000s. There's studies, there is reports, and this credibility of the Fed, this is huge. And that's why I'm like, it's funny because we hear it a lot now, and I really want you guys to understand this isn't something new. Even though we live in a modern world of media and fake news media, I know, and all these different things, it's like you have to understand this came from something. This is bigger than all of us. So what I want you to understand is that Fed credibility is literally the only way to bring inflation down. Or at the very least, this is probably maybe a failure of the system we're on, but most theories are built around a credible commitment from a central bank because everything is based upon central banks and floated exchanges and all of that. And that's why it's like, unfortunately, when it comes to lowering inflation, credible commitments from a central bank are a key part, and it's been like this for over 50 years. So the problem that usually arises, and this is what I'm going to talk about here, I want you to understand credible commitments, and then I want you to understand the time consistency problem is because in getting credibility and showing it and actually executing the goals, sometimes different goals at different times make it harder to prioritize, and that is what gets in the way of things. So don't take my word for it. This is from International Political Economy by Thomas Oatley, and he does reference those sources, Kidlin, Prescott, Keach, and Drazen, as they discuss this, but it's saying the time consistency problem. Though most governments were determined to achieve and maintain price stability, few could easily do so. Inflationary expectations were deeply embedded in society. The 10-year history of high inflation made workers and businesses expect inflation to continue in the future. These inflationary expectations, in turn, shaped wage bargaining, giving inflation a momentum of its own. And let me pause real quick. I believe this book that I'm reading from was written in 07 or 08. They've updated it throughout the years, and then it's referencing what happened in the 70s, but I'm sure this all sounds familiar. In order to end inflation, each government would have to make a credible commitment to price stability. That is, each government would have to convince workers and businesses that it was truly determined to bring inflation down and keep it down. So do you guys get what I'm showing you? This is a strategy, and this has been a part of political economic strategy for years now. to convince workers and businesses that they're actually trying to bring it down. A government cannot easily make a credible commitment to low inflation, however, because of something called the time consistency problem. This was brought forth by Kydland and Prescott in 1977. A time consistency problem arises when there is an inconsistency between what is the best course of action in general and what is the best course of action at a particular moment in time. So let me modernize this a little bit for you. You got to think about it. At some point in our history with this inflation battle in the Fed, we were saying, yeah, we want inflation down and we got to bring it down. But now think about it, how you went about that. Things probably got in the way, from either the war to a supply chain issue. Those could be some of those other factors you could think about. But continuing, examinations provide a good example. Professors are principally interested in getting their students to learn the material being taught in the course. Examinations are important only because they force students to study more than they would otherwise. As the semester begins, therefore, the professor's optimal strategy is to schedule a final exam for the course. Without an exam, most students will study less, but with an exam, students will study harder and learn more from the course. Once exam day arrives, however, the professor's optimal strategy is to cancel the exam. Because they expected an exam, students have studied and learned as much about the material as they can. Giving the exam is pointless. Moreover, the professor is better off if he or she does not give the exam. She does not devote time to grading the exam and can instead use that time for other purposes. The students are better off, for they are spared the time and anxiety associated with taking the exam. Thus, the professor's optimal strategy at the beginning of the semester, declare that a final exam will be given, is not her optimal strategy at the end of the semester. The professor, therefore, has time inconsistent preferences. So it goes on and it talks about government and time inconsistencies and monetary and fiscal. And I could go over this if you guys would like. I love this stuff. You let me know, but I really hope you got that example with the teacher. Imagine your teacher comes in and says, hey, you have to study for a final. You have to study for a final at the end of the year. And everyone's like, oh, yeah, we do. We got to get prepared. It's going to be really hard. And then you get there on the final, and then teacher says there's no final, but I'm glad you studied. That's it. You passed. Thankfully, you prepared. I know you're ready. And then they're like, I don't even want to do the work. We both win. Win-win, baby. 50-50? No, I don't know. You'd be like, what? But listen. I want you to think about that in terms of the Fed right here, right now, 2024. It's like, and think about the front run and the Fed concealing and why things are so confused. Bro, it's a time inconsistent preference, and maybe this is Powell. Maybe Powell just gets you ready for the exam only to cancel it, or who knows? What is the exam? I don't know, but I think that is great food for thought to leave you on. So, Chad, I hope you enjoyed this one as much as I did. But that is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, baby, you feed the wolves. You feed the hunger, the good or the bad. And you choose what's for dinner. You're for dinner or what you want. It's one or the other, baby. But Chad, I will see you in the morning. Drink that water. Stay hydrated, healthy, all that good stuff. And horn.